Every indicator you use behaves differently in a trend versus a range. ADX tells you which regime you're in. It doesn't care about direction, only conviction. Master it, and you'll stop fading strong trends and stop chasing weak ones. ADX is built from the Directional Movement Index. For each bar, plus DM is today's high minus yesterday's high, when that exceeds yesterday's low minus today's low. Minus DM is the opposite. These raw values get smoothed over 14 periods and divided by average true range to give plus die and minus die, the two directional lines. Now the clever part. Wilder takes the absolute difference between plus die and minus die, divides by their sum, and smooths it. That gives you ADX. When the two die lines diverge sharply, ADX rises. When they tangle together, ADX falls. So ADX is literally measuring how separated bullish and bearish pressure are. The classical thresholds. Below 20, the market is range-bound or trendless. 20 to 25 is a developing trend. Above 25, you have a real trend worth riding. Above 40, the trend is strong but increasingly extended. Above 50, expect exhaustion or at least a sharp pullback. For directional entries, watch the die lines themselves. When plus die crosses above minus die while ADX is rising above 20, that's a long bias signal. The reverse, minus die crossing above plus die with ADX rising, signals a short bias. The crossover gives you direction. ADX confirms the move has fuel. Here's the nuance most traders miss. A high ADX value isn't bullish or bearish, it just means a trend exists. What matters is the slope. A rising ADX confirms the current move is gaining strength. A falling ADX, even from a high level, warns that momentum is fading and a pullback or range is likely next. Look at this synthetic uptrend. Price grinds higher, plus die pulls above minus die, and ADX lifts from 18 through 25. That's your green light. Notice how ADX keeps climbing while price extends, then flattens near 40. The flattening, not a die cross, is your first warning to tighten stops or take partial profit. Here's Apple on the daily. Watch how ADX sits below 20 during consolidation phases, and the die lines whip across each other, generating noise. Then a breakout occurs, plus die separates cleanly, ADX punches through 25, and a sustained trend follows. The filter is doing exactly what it's designed to do. ADX is heavily smoothed, so it lags. By the time it crosses 25, a chunk of the move is gone. It also can't distinguish a sharp one-bar spike from a sustained trend until several bars later. And in choppy markets, die crossovers fire constantly, generating whipsaws that ADX confirms only after you've already been stopped out. Pair ADX with a breakout system or a moving average pullback. Use ADX above 25 as a green light to take Donchian breakouts or trade in the direction of the 50-period EMA. Conversely, when ADX is below 20, switch to mean reversion tools like RSI extremes or Bollinger Band fades. Let ADX choose your playbook. ADX rarely shows classical divergence because it isn't directional, but watch this. When price makes a higher high while ADX makes a lower high, the new push lacks the conviction of the previous one. That's a strength divergence, and it often precedes a trend change or a deep retracement worth respecting. 3 mistakes to avoid. First, treating high ADX as a sell signal. It's not, it just means strong trend. Second, trading every die crossover regardless of ADX level. Third, using the default 14-period setting on every time frame. Shorter settings on intraday charts are more responsive but noisier. Test before you trust. Tomorrow, add ADX to your charts and do one thing: tag every setup with the current ADX reading and slope. Within a week, you'll see which of your strategies need a trend, which need a range, and which work in both. That single habit will sharpen your edge faster than any new indicator. This is education, not financial advice. Trade your own plan. If this helped, do me a favor. Hit the like button, subscribe, and tap the bell so you don't miss the next one. See you in the next video.